Good afternoon, everyone. My name is Brian Overby. I am the Senior Options Strategist with OptionsPlay. And today we're going to talk about outsmarting zero DTE credit spreads. We're going to look at an alternative, which a lot of people don't think of it as an alternative. You might have heard of a modified butterfly before. I prefer to call them skip strike butterflies. Inside my book, I refer to them as skip strike butterflies. And I'm going to go into great detail as to why that is. But one of the biggest things about a skip strike butterfly relative to a short spread or a credit spread is the fact that you have a hedge built into your trade. And there's always a trade-off for that hedge, but we're going to talk about how a skip strike might be more enticing than just doing short spreads in zero DTE option contracts. So with that said, there are chat boxes. There's a lot of people that are here in this event, and there is a Q&A box. Now I'm going to focus on the Q&A box. This is a live session. If you do put some questions inside the Q&A, I'll be happy to answer those questions throughout the event. The entire event usually lasts about an hour, but if we get a lot of questions, we usually do go a little bit longer than that. And the PowerPoint and everything will be made available to you after the event is over. So with that said, let's get started. All right, options education. So as far as OptionsPlay is concerned, our biggest goal is to educate our members and everyone alike about option trading. So we do these events every Thursday. 4:15 is usually the kickoff time. We had a little bit of problems getting kicked off today, but 4:15 p.m. Eastern time every Thursday we do a seminar that's kind of here and now. We're usually trying to focus on topics that a lot of people are talking about and trying to educate around those here and now topics. So join us every Thursday, and we're going to be showing the OptionsPlay platform today, and I want to highlight the fact that nothing is meant to be a recommendation, and we will be using real data, and past performance is not a guarantee of future results. Okay, we got that out of the way. All right, if you'd like to use some of the tools that I'll be showing today, please scan this QR code right now, and you will have access to a 30-day free trial of OptionsPlay, no obligation whatsoever. You can also just go to the OptionsPlay website, and you can sign up directly there, optionsplay.com. Every Monday, Tony Zhang, our chief options strategist, goes through a research report that he puts together meticulously, and he talks a lot about stocks that we actually use in our daily play. So a lot of his research leads to the strategies that we use week in and week out. If you'd like to see some of that research, just click this little QR code and you can sign up for all the events. If you can't attend, that's fine. Just register for them and you'll have your spot saved. But it's an hour-long research report every Monday morning at it's either 8:15 or 8:30, 8:45 kickoff. That's what it is, 8:45. All right, so we have the 4 basic option strategies here. If I'm thinking about doing the strategy that I think is very common, very well liked, is the short vertical spread. And we've done a lot of seminars about short vertical spreads where you are selling an option contract that is more expensive and buying an option contract that is further out of the money and that is less expensive. Today, I'm just going to focus on the call side of things because we're going to introduce a strategy that goes along with that short vertical spread. And I'm just going to introduce it on one side, and then we're going to show you a couple of trades inside the OptionsPlay platform. But the one that we're looking at doing is selling a short call spread. So we're going to sell, and that sell is going to bring in premium. We're going to sell an expensive option contract, and that will give you an obligation to sell your stock at that strike price. We are then going to go further out of the money and buy a cheaper option contract, and that option contract will give us the right to buy that underlying stock at a different strike price. Now, the width between the strike prices is applies to the maximum width of the trade and the maximum width of the trade. So that would be the margin requirement. You can use the net credit that is received from the trade to offset that risk. But we're going to see a similar thing when we get into our butterfly trade, our skip strike butterfly trade, that will have the same type of margin requirement that you would have on a short spread, all via using call options or using put options. All right. So here is the bear call vertical spread. So we recently did a seminar on vertical spreads, and this slide comes directly from that presentation. But here's our max reward. If we ever do a bear call vertical spread, one of the things that if you put it on, the stock is usually trading below where your strike price is at. You're bearish on the marketplace. You want the market to stay where it's at or go below. And if we do that, well, then we have limited and known upside. Whatever we receive for the net credit is the possible maximum reward. So it's limited to the net credit received when you set up the strategy. The maximum risk would be the difference between the strikes minus that net credit. So when we're doing call vertical spreads, usually your reward is less than your risk. In this marketplace, and this is one of the things we talked about in the last seminar that we did, we're seeing just with the skewing of volatility where you're getting a very solid risk reward ratio on credit spreads. And that's part of the reason why I wanted to introduce the strategy today as an alternative, is because we're seeing that dynamic in the marketplace, and it has a lot to do with where volatility is at, and just I don't know, the general craziness of the markets recently. So our break even is the short strike, which is this strike price minus that net credit received. Now this would be the stock line, and that would be where our break even point would be at on this trade. Now, if I look at the skip strike butterfly with calls, I want to highlight the fact that this is a very similar trade. Now, a lot of people think of this as an alternative to a butterfly, but I like to think of it as an alternative to a short spread. And here's the reason why. Now, the max reward is in general, I like to think of it as the net credit that is put on when you first establish this trade, when you first put this trade on. Now, there is because of our hedge, you can actually put the trade on for a net credit and then take the trade off for a larger net credit. So you're putting it on for a credit and taking it off for a credit. Now, that only happens if the market actually goes against you in a way, and I'll explain the rationale there. And the market actually closes close to your short strike of your butterfly. So if we put this trade on, once again, this is the stock price. Stock is usually trading somewhere around here below the strikes that we're looking at doing. We are using call options, and we're going to try to establish this for a net credit. Now, the break even and the max risk is hard to figure out, especially if you don't have strike prices, where we're trying to do it generically here. But it's the skipped strike, and this is the strike price that really drives the strategy. And this is why I like to call it a skip strike butterfly as opposed to a modified butterfly. But if we did a normal butterfly, what would happen is we have the butterfly, and we pay a net debit for it. Butterfly would be down here below the zero line, and that would be representative of the maximum loss if the market went down. You would have the TP in the middle, which would be the ideal situation, and then you would also have a minimal loss if the market went up. By skipping this strike, we're literally embedding the credit spread that's in it. So to figure out the max risk, you got to actually know that strike price that you're skipping. So it gets a little hard if you don't do it all equidistant. But in our examples, we're going to talk about equidistant ones. And the example I'm going to use inside the OptionsPlay platform will also do that. Okay, so let's look at the setup here. And if you do have questions, do put them in before I get into the full setup of this. Let's put them in the Q&A box. I see a lot of people are chatting amongst themselves inside the webinar chat, and that's awesome. That's great. That gets a little bit full and it gets a little bit hard to keep track of. It's easier if you actually took the time to put any questions that you may have actually inside the box that has the question mark on it that says Q&A. All right. So the skip strike is actually a combination. Now, once again, I'm focusing on calls, but you can do this with put. So what it really is a combination of is the butterfly strategy. And I show you the profit and loss graph here of the butterfly. Here's the long butterfly. And then you add a short vertical spread. So we're going to actually take these two graphs, the long butterfly and the short vertical spread. And if you do that, that actually works out to the skip strike butterfly. So now in this instance, if that is the case, what you're looking at here is what is the margin requirement of this short spread. And that is going to be your margin requirement on your skip strike butterfly. And that is also going to help you figure out your max risk on the trade. So if we look at these two trades, what we are combining is this strike. This is the strike that I'm selling, and this is the strike that I'm buying. So if I buy and I sell the same option contract, well, why even do it? Why not just skip that strike? And that's the way to approach, and that's the concept. Another way to say this is that we are going to bring in a net credit for selling the vertical spread, and then we are going to use that net credit to pay for the butterfly. So give me a second here. So in this instance, if I'm doing this, I need enough of a credit from my short spread to pay for the butterfly and actually have a net credit in my account. So if we look at this and we combine these two trades, what we end up with, and I'm going to go back one, is the skip strike butterfly. So look at these two profit and loss graphs, long butterfly, bear call spread. Combine those two, you end up with something that looks like this. All right. So I took the time to grab probably the most popular stock on the day, Nvidia. And now that they've announced earnings, Nvidia, if we're looking to do these type of strategies, even like short spreads, you know, I always like to use the phrase that you want some volatility and some predictability. You need to have some premium in these option contracts, especially to pull off a skip strike as an alternative to a short spread. And Nvidia has that. It has some volatility and some predictability. It's been much harder to predict where it's going recently because news headlines have been, driving the stock up and then driving it back down and then driving it back up. So it hasn't had a ton to do with the fundamentals. The news has actually been a big part of this actual volatility. But in general, Nvidia is more volatile than Apple. This strategy is going to be more plausible in an Nvidia option chain than in an Apple option chain. All right. So here's our example. Now, these are actual screenshots from the OptionsPlay platform of butterflies taken at that moment in time. So here's our skip strike butterfly. We going out to July 18th. Now, we had to go out 50 days, and that had some, I usually like to do it a little bit shorter, but it had a little bit to do with what expirations were available. But in our example, we're going to go out 50 days. I know it's not a zero DTE thing, but just trust me, I needed this to try to explain why we're setting up the trade that we are. Okay, so we're buying the 145 strike call, and then we're selling 2 of the 150 strike calls, and then we're going to skip the 155 and buy 1 of the 160 strike calls. Nvidia at the time was trading for $140. The stock actually went down. I don't know where it closed at today, but it went above 140 and then came rolling back down. And then, so we were right around 140 when I grabbed these screenshots. And I wanted to show you how the math works. So I went out and actually did the standard butterfly. And I'm just wondering, are there a lot of people out there that are there some people that have done some butterflies over time? And if you have, just let me, you can actually toss it in the chat box if you want. Have you done a few butterflies? All right, that's great. So we got a few people out there. Yeah, Jan is saying, is this a broken wing? It is a broken wing, but I don't like broken wing. And here's the reason why. And I'm going to show it to you today because we're literally skipping the strike, which is embedding that butterfly. So here is our butterfly. And this is all written out. And an actual order entry. The midpoint is 54 cents. 54-cent net credit for our skip strike call butterfly. Here's the standard butterfly. 145, 150, 155. That is a 48-cent net debit to the account. So your max risk is 48 cents. Your max upside is if it goes to 150, and you can make the width between the strikes, which is 5 points, minus that 48 cents, and that would be the maximum upside. Now, I'm going to say let's introduce the short spread. And you'll note that we're going to sell to open the 155 call, and we own the 155 call up here. But we're going to sell that one to open, and then we're going to buy the 160. So this is $3.15. This is $2.13. That's $1.02 is the midpoint. So now let's do the math. This is a net credit to the account. This is a net debit to the account. Over here, we end up with a net credit to the account. So 102 minus 48. Oops, I got the decimal in the wrong spot. It's supposed to be right there. 0.54 is the net credit to the account. So let's just fix that real quick. And if we do this now herein lies the reason why I like the skip strike. So effectively, by putting this together, we are selling the 155 call and we're buying the 155 call and this whole gaggle of option contracts. So why even do it, right? You got one strategy that's selling it and one strategy that's buying it. Why don't we just skip that strike? And realize that when we do that, we're embedding risk. We're going to be putting in 5 points of risk, which is the standard risk on this call vertical. And now here's the trade-off. And here's what you have to decide. Do I want to do this trade and receive almost double the net credit, right? 102 is the net credit on the short spread. Or do I want to embed my hedge in it and receive half of the net credit? And that's ultimately usually the goal. And in order to do this, and I see somebody pointed this out, I saw it in the chat when I was running over there. And what the point of this is that if I do this, I have a hedge that's embedded in the trade. Now, how does this relate to a skip strike or a zero DTE trade? Well, if you're just looking at credit spreads on a zero DTE basis, this is an alternative, and we're going to look at some examples that are shorter term trades, not 50 days out. This is just a really good example to set up the point across. And ideally, if you were thinking about doing verticals, we do verticals all the time in the OptionsPlay platform as part of the daily play. And a lot of them will go out 30, 40, 45 days and put that trade together. Well, this is an alternative to that trade if you want to have something that can help manage your risk. So you go from a profit and loss graph that looks like this and this for the butterfly to now something that looks like this. And if the market goes against you, you have 5 points of buffer that can help you out. You bring in a smaller net credit, and if the market does go down, and that's my whole vision here, is that you're thinking the market will go down or stay the same. But I still have risk. I still have this spread back here that is scary risk ultimately just from doing a short spread, but I have a buffer and it allows me to stay in the trade a little bit longer, as opposed to saying, oh man, I did this and I've lost double my net credit. Well, in this instance, you might be able to hang around because as the market approaches expiration, this is going to pay you out. So it's a much different way to approach a trade. And on zero DTE trades, you don't have that choice whatsoever. All right, so bear call vertical spread, skip strike butterfly with calls, long butterfly short call spread combination. And here's an actual example that I put together today in Nvidia, which I do think is an interesting trade because Nvidia has a resistance point right around 150. And so if you're targeting that area to see where the most recent high in Nvidia was, this is one way that you might do it. Now, you could sell the 155 call, and that's going to be below the buffer, but that's a solid, I like both of these trades, right? You got 5 points of risk and you're bringing in $1. Here you have 5 points of risk and you're bringing in 48 cents. So notice the risk here, the reward is 450. The risk isn't 550. Oh, that's the net debit. I'm sorry. Here it is. This is the one I want to look at. So the reward here is $5.50, well, it's 54 cents, so it'd be at $554. And in this instance, look at my risk reward. Now, this only happens if the underlying market lands at the short strike. I'm sorry, I was looking at the wrong one. But you have a much more chance for upside. The risk reward is a much different ratio than if we look over here and look at that short spread in general. So interesting alternative, and I'll leave it at that. Anybody have any questions on how a skip strike works and how it's set up? Okay, so Joe, what's the exit strategy on this type of trade? I'll get to that. Can you talk about how to manage this? Yes, we can. You get a little bit more flexibility, and I'm willing to do them a little bit shorter term because of the hedge. Commissions and exchange fees, yep, you would have to pay those without a doubt. We'll talk about where to set the short strike. Now, right now there's not a scan for short strikes in the options play, but I would look at it as what was I thinking about doing with the short spread and then adding the butterfly to it. Talk about zero DTE strategies. Yes, this is an alternative to one. One of the things about a zero DTE, Robert, is if we're doing zero DTE strategies, there is about 10 times the risk of doing short spreads on zero DTE basis, in that if a market goes against you, it hurts. Now, the hardest thing about the zero DTE relative to a short spread is trying to get this done for a net credit to the account. So vols have to be elevated in order to do this. And we'll look at a couple of trades inside the platform that might be a couple of weeks out. We need the VIX at 30 to work in the SPY, for example, is a lot more enticing than the VIX at 20. When you're looking at these type of trades, it adds volatility, which adds premium, but obviously it also adds risk because it's adding volatility. So it's kind of one of those catch-22s. All right, so before I go to the platform, I want to show the QR code one more time for the free 30-day trial of OptionsPlay. And that's my book is inside the OptionsPlay book. I do have a write-up on skip strike butterflies. OptionsPlay.com is where you sign up to get the free 30-day trial. And my X.com handle is at Brian Overby. All right, so I'm going to back out here. And I'm going to pull up the OptionsPlay platform. And I'll leave it up to you. Do you want me to search for a little bit of a different trade in the SPY? Or would you like me to show you the actual Nvidia trade that we just set up? And I can talk a little bit about that. So to start with, you're getting bullish and bearish trades. Nvidia's everything is pretty bullish. We didn't break the 140 level. I'm just seeing the quote right now. That makes me a little sad, kind of wishing that we would have finished above 140. And I noticed that we set that up in our portfolio as a daily play. So I went in today inside the portfolio and I actually put together the Nvidia skip strike butterfly that we talked about. So here are the details of the trade, and this shows you our profit and loss graph right over here. Here's your setup. I don't want to put my cursor on it. Everything keeps popping up. But notice here's the profit and loss graph at expiration and as of right now. And here's the one thing that I want to show you that I want to talk about. Okay. We still have 45 days to expiration. We need time cut in half for the hedge to work. And I'm highlighting this, and maybe here, let me zoom in a little bit. How come I can't zoom? It's not letting me zoom. Okay, so I'm going to ask you to focus on this little area here, but this is the profit and loss graph. Like when you first start this trade, you have the net credit received, and everywhere below this short strike, you're profitable. But if it goes against you to start with, it helps, but it doesn't remove all the risk. And as expiration approaches, that line obviously is going to dwarf on the way up to reach the center strike of our trade. And over time, as time decays, our hedge helps us more than it does initially on the trade. And if you think about, this is the same way that it works with just a short call spread. So you put the trade on, you have the hedge. Part of the reason why, if I can get this done for a shorter term trade as opposed to 50 days in our example here, and I can go at a shorter distance and get it done for a decent net credit to the account, then if it goes against me, my hedge rewards me more. So let's go in, and this is a simple one straight up, but this is a trade I would look to do in Nvidia. I wouldn't have any problem with this if I was a little bit more bearish in the underlying stock, right? 145, 150 is very feasible for it to reach that level. If we closed above 140 today, I think that is just a technical area. I think it's very interesting that we closed just below, considering that we opened up above. And interesting in a bad way, let's put it. Okay, so with this said, we have this position on, and we'll go in and look at a shorter term trade in Nvidia. So let's go back to here, and we're going to hit modify. We're going to go and look at, let's go 22 days out. Now, 15 days out, when I looked at them earlier, it was kind of hard to get that done for a decent net credit to the account. We would have had to tighten it in quite a bit. Let's try it. Let's try it. We have to tighten it in. We might have to go 2 points wide as opposed to 5 points wide. So the further you go out and the wider your strikes, the more net credit you can do and receive for that trade. So in this instance, we're going to have to add a leg. We're going to buy one, sell two, and then buy an additional one. The stock's at 139 right now. Let's look at doing, well, 440, 375, 250, 254, that's 5. All right, I'm going to go 2 points wide just to make this as simple as possible to show the net credit to the account, okay? So if I put this one on, we're going to buy the 142 strike. We're going to go 2 points and do the 145, and then this would be 4 points. We'll skip the 147 and we'll do the 149. Yeah, 30 cent net, 13 cent net credit to the account. Uh, I'd like it to be 20 cents. I would like to be closer to 20 cents on that trade. The ask is 20 cents, but you're only going 2 points wide. You have 2 points, $2 worth of risk. 10% would be my goal to try to get the trade set up. So I would maybe go out an extra week in order to do this trade. But if you want to do the shorter term trades as an alternative to doing the short spreads that have the very, you get rewarded so quickly, but if they go against you, they hurt so bad. This is an alternative trade to that. We're going to go out 15 days, set this up for 13 cents if we can put on that trade, and have $2 worth of risk. Now, it's only $2 worth of risk, so you can increase your contract size if you want to do that trade in that way. So if we're doing this trade flat out, that's the way. Scott, you said that you did the same strikes and have a 49-cent net debit. No, I don't think so if we're going back and looking at it. Because if you look at the trade, Scott, this is above here, right? This is where it's at. So this was done for a net credit. Now, the stock might have moved. It's possible that the stock moved, but I highly doubt that it would have moved that much, Scott. So I think he set it up wrong. Same question as Joe. It's still a little hazy, and how does one close the trade? Okay, so if you're closing the trade, you're going to close it as 3 legs. So let's click on this. Since I have this inside the skip strike portfolio, and you click close position. Now you click trade. So you're literally going to take the exact opposite side. You did a buy, you did a sell, you did a buy, you do a sell. So in this instance, you're selling 1, buying 2, selling 1. And this now would be done for a net debit of 58 cents to the account. It's very possible, and I've been able to do this before, where the market comes back into your strikes and you're able to actually do this for a net credit to the account if you do that trade. And you can add that position onto your trade. So if we scroll on this and I hit add position, that would close out the trade. Now, here's where I find these trades really interesting. We'll stick with this one. We'll go back and we'll look at this underlying. Let's close it up. And refresh this portfolio. Here's where I find this the most interesting. Yeah, then there, I hit it just right. Okay. So as expiration approaches, and think of, and look, gosh, I really wish I could, why can't I zoom? There we go. All right, it wasn't allowing me to zoom earlier. Okay, now we can zoom. So now I'm here, and let's say you put this trade on. You know that this line has to approach the peak as the expiration approaches. That has to happen in the butterfly when we get to expiration. So if you're sitting right here and you put this trade on and now you only have 10 days remaining to expiration, if the market starts moving against you and all of a sudden you find yourself at a loss, and I'll move it to a loss, eventually that can become a gain. Okay, so let me say that again. So very schizophrenic type profit and loss graph. As time premium comes out of your short options in the middle of your strike and expiration approaches, you might have a loss now, but if the stock stays there and specifically finishes right here, you're going to have a gain on that position overall. And that gain is going to be quite large, because if it lands somewhere close to the middle strike, you're going to be all right. So I like to do these type of butterflies, and if you talk about it on a 1 day basis, on a 0 DTE basis, Amazon likes to announce earnings on a Thursday. Um, do we have something that's announcing right now into the close? If we do, anybody got a suggestion? A volatile one? Costco. Yeah, Costco's not bad. Costco's probably have. Dell might have a little bit more vol. Let's look at both of those, okay? And then you can look at setting up a 1 day skip strike butterfly in them. But once again, you need some volatility and some predictability. So now I need to reset this. Control 0. I did it. I pulled it off. And Dell is out. It doesn't matter that it's out though, because we're not setting up the trade. Okay, and I want to emphasize this. We're not setting up the trade for you to go tomorrow and put the trade on, right? I'm going to give you a scenario where it's interesting. If you were thinking about doing a short spread on a company to speculate on earnings, this is an interesting alternative when they have 1 day remaining to that expiration. So in Dell, if we look at Dell, the quotes will still be from the close, right? Even though they might have already announced earnings and whatever may happen after earnings. Okay, so if we look at Dell, and let's start by just doing trading range. We're looking at a 1 standard deviation move is about 133 down to 93. And implied volatility is about 47. Okay, so vol isn't explosive on this one. But we'll try it. We'll try it. Okay, let's go in and modify, and I just grab any of these. We can say high implied volatility. It doesn't necessarily matter which one you're setting up, because we don't have a specific scan for skip strike butterflies. That may be coming, especially if I continue to do seminars like this and they're well received. But at this point in time, we don't have that capability. I'm going to modify this. Do the bid ask. We're gonna go. We're just gonna adjust it this way. Okay. So we will be buying one option contract. We'll be selling another option contract, and we're gonna be doing the very short-term expiration in May. Okay. So. The 114, yeah, that's trading for $4. So the expected move is about 860. If we bought the most at the money put and the most at the money call, we're going to talk about $8. So we're going to go a little bit less than that to set up this trade. So we'll be looking at about 6 points is where we probably want to buy this. Let's look at buying. We're on the call side. This needs to be a call. That would have screwed things up. We need to buy the 120, and if we sell the 122 isn't bad. 122, that's right at the expected move, 8 points, right? And then we skip the 122, 124 and go to the 126. So 142 times 2 equals 284 minus 180. 284 minus 180 minus 0.62. 42 cents. Yeah, not bad. That's not a bad one. That's not bad at all. Okay, so let's click trade. And that's a 42-cent net credit to the account that we can get this done for a 2-point wide trade. We're the expected move out of the money, 122, which is 8 points. We're skipping the 124, and that's why I like it skip as opposed to modified. Adding a $2 margin requirement to this trade. I did do that. That's right. Yeah. Yeah. So that's a very interesting trade. What do you guys think? And we just did that off the cusp. So if you're looking at zero DTE trades, this to me is much more interesting in that if I put this trade together, and I'll send this to the skip portfolio so we can paper trade it. Position has been added. You might even be able to go a little bit wider. So if you go a little bit wider, and you can get that done for 15 cents, then you got 3 more points of hedge inside your trade. Realize this is still a risky trade in that you have a short spread on, and Dell could gap double the expected move. But everybody knows what I mean by expected move, right? I'm assuming that. The expected move, and we can get to that real quick, like if I go back to this trade, is just what the long straddle is. So if we click, let's modify this, go here, 1 day, bid ask, call and put, and hit trade. Yeah, I said $8 and some odd cents, but the expected move around earnings, if you've heard that quoted many times, is literally a pundit looking at what the most at the money long straddle is trading for. And then if you take that and you divide it by the stock price, so you say 8 divided by 113, and you say Dell is expected to move after earnings around 7%. No regard to direction. It's just saying people are betting, and if you could think of it as an over-under, if you know that terminology that is used in sports betting from time to time, how many points are going to be scored in a football game? Do you want the over? Do you want the under? Well, if you're willing to pay $8, guess what? You want the over. And if you're willing to receive $8 for this straddle, you want the under. And so that has been coined as the expected move around earnings. So there's a great example of one. Now, once again, this trade won't be available because they already announced earnings. But if you're thinking about going out and doing a bear call spread, so the bear call spread, let's just look at what that would be, just to show you that I'm not pulling your leg here, right? So let's modify the bear call spread. Let's go in here. Short stock. Then we want to modify this one. Oh, I'm short stock. Why am I short stock? Let's go high implied volatility. We'll do there and we'll hit modify. All right. And we'll go here. And we'll go here. Okay. 1 day. Short. Oh, we want to do the call side. We got to do the call side. We want to go out in strike. Stock is 113. We were looking at 122. We skipped the 124. Does everybody agree with me on that? We skipped the 124. And our hedge would have been the 126. And flip it. There we go. There you go. Trade it. 26 cents. I wouldn't pay for that. So that doesn't compute. So if we set that up, if you're looking to do that trade and get that done for a net credit to the account, I think might have to go out an extra week. Let's go in. That trade was 26 cents, and let's look at what the butterfly was then. We'll set up the standard butterfly. Let me modify this. And then I'll try to get to some questions on it. Let's see if it works out. So we're buying, we're selling, we're going to add a leg. We're going to look at call here. We're going to add another one of these. We're going to go 120, 122, 124. And that's 8 cents. Yeah, I guess so. I mean, we could get it done for 20 cents. I don't know where I came up with 40 cents earlier, but so this butterfly is 8 cents. The net credit was 20 cents. We're looking at getting 20 cents for that trade. That's 10%. 10% of the margin that is put up. That's a solid trade. Putting it all together with 1 day remaining off the cusp. We can look at it a little bit on Costco if you want to keep going. But if I'm thinking about doing credit spreads around earnings, to me, this is the most interesting alternative on a 0 DTE basis. Now, in Dell, they don't have 1 day option contracts, but there's a lot of companies that announce on a Thursday. Amazon always announces on a Thursday, and then you have 1 day option contracts in your Amazon position. Or if you look at companies that announce on Wednesdays. But I'd rather look at companies that announce on Wednesdays and Thursdays than opposed to companies that announce on Mondays, right? Where you don't have that shorter term option contract. Because what you need is time decay. You need this short option contract to go away because this is adding risk, and you've sold 2 of them compared to buying a deeper at the money and a little bit more out of the money option contract. All right, so I got a lot of questions. How about I answer these? Where are we at as far as time? We're looking pretty good. I'll answer a few of these, and then if you want to, I can try to set one up in Costco on a 0 DTE basis. This should be June, not July. I don't know where we're talking about that. Oh, shoot. Oh, that's what it is. Oh. All right, that's why I was confused. All right, it's June, not July. Thank you, Myron. But it still worked out in that range too, but that's exactly why the credit was so different. Let's do a Costco 0 DTE. Okay. Expect a 1 standard deviation move? No, I expect the expected move. G Tom, you know, I'm not looking at the 1 standard deviation move. You're looking at the expected move. Now, if you do get more than the expected move, you're still okay on it, you know, up until the point where you're getting about 1 standard deviation move, which only happens about 16% of the time. At least the math says that. If you go a little bit further out in time, you can try to do that, Tom. But, you know, we're trying to look at it as a 0 DTE trade. And if you're doing that, this is a very interesting alternative to the 0 DTE. Somebody wants to look at the Costco trade. Now, let me go over it. If you got the Q&A questions, I promised that I would look at those first. So these are the questions that are inside the Q&A. Let me look at that. Why not do 2 skip strikes? Well, William, you can. You can. So that's an alternative to an iron condor. But that's just a lot of trading. That's a lot of, I don't know. I don't do that often. Can you comment on the liquidity of these trades? What liquidity risk do you have? Okay, yeah, liquidity is an issue. Like Dell, liquidity would be an issue with Dell, without a doubt. Markets are closed. The options are going to be kind of wishy-washy anyways. But it does help if you enter it all as one trade to enter a 3-legged trade versus a 2-legged trade. And it's mainly because if you come to the floor as a package, market makers like the package. They would rather trade with you if you give them their hedge built into the trade. Much the same reason why I kind of like doing skip strike butterflies more than I do just doing a short call spread outright. Now, it's a totally different trade, and you got to have the right underlying to do it. Dell would not be that underlying if it wasn't announcing earnings, right? That's the only reason why we looked at it is because it was announcing earnings after the close today. All right. Yeah, we made it anonymous. We made it 0 DTE. I just needed to explain it on a longer term basis, and I think that works with longer term options better. I don't see. Yeah, Kel, we can use deltas to pick the strikes. If I'm looking at earnings, I always do like to do what I did around the expected move. That short strike delta is gonna be close to 20. And that's usually about where the expected move lands. It's a little less than a one standard deviation move, and that's just the way the math usually works out. Sheldon Natenberg's book, Option Pricing and Volatility, explains it, but there's no real. So if you're going to look at it, you're going to look at selling something that has close to the 20 delta. The Nvidia example. Well, if I'm managing the trade, I'm still going to look at it just like a short spread. If I put that Nvidia trade on for 50 cents and I can close it out for a dime or 15 cents, I'm going to do that. Now, if the risk goes against me, it does depend on where you are at the expiration date. If it goes against me right away, I want to get out of the trade. And my rule is that if it hits the short strike within the first half of the trade, I'm just going to close it and get out. Just like I would if I was in a short spread, right? I'm going to take kind of the same aspect. You can also say to yourself, well, I put it on for 50 cents. If it starts trading for $1, I'm going to get out. I don't want to lose more than double the net credit that's received. I usually let them ride a little bit more. I always stand by the rule that if it hits the short strike, no matter where it's at, the short strike of the butterfly, right, of the butterfly, then I'm going to get out of that trade. That's my general rule. I always do that. But I can give it a little bit more play because of the time decay issue. Exactly what we're talking about in this trade, and that as time decays, this trade actually gets better when it starts going against you as opposed to a short spread. Yeah, 0 DT moves really fast, and that's true, very true. If I'm doing a 0 DTE trade, I get high risk, high reward, right? Very high risk, very high reward. And if the market goes against you, it really hurts in short 1 day credit spreads. You got a chance here if it goes against you. You're kind of okay. As a matter of fact, you don't really mind it if it does. Now, what's the ideal scenario on the Dell trade? If I put in that Dell trade and brought in a small net credit to the account for doing it, and the market went against me, I'd want it to drift against me, right? I don't want to hit the 122 strike right away. I want the market to just slowly go up towards that and then expire close to the end of the day at that level. If it gaps open on an earnings, that's a warning. And that happens on anything, right? It doesn't matter if you're in a short spread, if you got a long put option on or whatever, and the market gaps up, you're going to get cremated. And there's just nothing that you can really do about it on that trade. So the Dell 45-day trade, I find that interesting if you're thinking about doing a short-term trade against it. No, I'm sorry, the Nvidia 40, I think it was a 50-day trade on Nvidia. I do like that trade as an alternative to just doing the short spread for $1. I'd rather do the skip strike butterfly for 50 cents. And then I don't mind letting that one expire worthless either on the skip strike butterfly. So if the market goes with me and the market goes down, I don't feel as urgent a need to close it out as fast, because if it comes up closer to the expiration date, well, I might actually get the benefit of putting it on for a net credit and take it off for a net credit. I'd like to see a real chart, a chart of the stock. Okay, I don't have a chain. I have a chart. A chart of the stock. Skip strike butterfly with credit versus iron condor. Jay asks about skip strike butterfly with credit versus iron condor. Which strategy is better? I mean, they're different. The skip strike butterfly to me is more of a directional trade. The iron condor is a neutral trade. You want the stock to stay where it's at. I prefer to do skip strike butterflies. I like to try to pick a direction and lean in that direction on that underlying stock. The iron condor to me is more of an index strategy. I would do that in the SPX. I would do that in something that has a little bit less volatility. So I need to get two premiums to make the trade feasible. That's part of the reason why, indexes are less volatile, because they are 500 stocks in the index, in the S&P 500 index, and they mute each other as far as that's concerned. So I would say skip strike butterfly. Hi, IV. Hi, IV. And that's the very first question that I have. When does the strategy work best? High implied volatility, because you have to get that credit spread to pay for that butterfly. That's simple. That's straightforward. Now I'll go over and look at the chat. I see a lot of good chats. We're at 5:19. We still got time. You guys want to try to do the Costco one? All right, let me look at the Costco one. One standard deviation is 68. No, one standard deviation move, the delta. If you're going to look at the delta of the call option, that's one standard deviation away. That would be 16 delta. You have a 16 on the call side. You have a 16 delta on the put side. And then the body is 68 in the middle, right? As far as probability is concerned. Yes. Okay. All right. We'll look at the... Now realize these trades are meaningless, because the trade's already happened, right? I mean, implied volatility has gone away. Costco usually goes down after earnings. I don't know. Oh, this is a good stock because it's $1,000. That also helps, and I forgot that it was $1,000 for some reason. But the reason when you have you can have high implied, if you're just looking at a one contract basis, right? High implied volatility helps, or a 1x2x1 butterfly basis. And premium, you get more premium on a more expensive stock. All right, so let's go look at this one. Let's click here. Let's see where the one standard deviation move would be at. I thought I did this before, but I guess I didn't. I didn't click me. All right, bid ask trade. $31. All right, so this will be an interesting one. There's no doubt. $31 is the expected move. 1,000. So we're talking about 1,040 based off of the 110 strike. But it's going to be interesting because there may not be 1 point strike prices in it. Let's go back and modify it. Bid ask. Hit 1 day. Hit 1 day. Buy, sell is going to be sell 2, and then we're going to add a leg. This will be the call, and we're centered around 110, 122, 40 points out. Okay, so let's look at. So I'm going to look at the math real quick, like here. I don't want to set it up and waste the time if it doesn't look feasible. Yeah, this doesn't look bad, and I'll do it. If you can make the spread wide, opt to make the spread wider and take in less credit. That's what I would look to do on a skip strike. It might not be the case on a short spread, but in this skip strike, I would look to maybe do that. But we're seeing that the 1,035 is trading for 550, right? And times that by 2, you're bringing in $11, and this is trading for $6.80. So minus $6.80 means we got $4.20 that we want to pay less than for our skip strike. So we're going to go to the 140. That's 425. That's good news. And then we go to the 145, and that's 340. All right, 1 by 2. One day, everybody check me here. It's hard to, oh, this didn't do this. Yeah, okay, one, and then I didn't change the first one, did I? So 140. I did the math and I didn't do the changing. Okay, let me try this again. Why is that saying 340, 550? $135. All right, I didn't quite get the numbers right, but okay, 140, 135, 140, 150. Okay, so 413 is the call. 826 minus 425 and minus 275. 126. Net credit. All right, not bad. Okay, so this is 5 points wide, and I'm going to actually screenshot this one. And so you're going 5 points wide, and you have, here's our skip strike is the 145. I don't know why that first quote looked weird to me. I don't get why that was. But here's the 30. We're 1 day remaining to expiration. 130, 140. 140 is about where the expected move is at. Skip to 145 and buy the 150. Now you can slide it up a little bit because you're bringing in a decent credit, $1.26 on this trade. That's a solid credit on a 5 point wide trade. If I could get $1, I'd be feeling really good. My general rule is about 10% of the risk. So if I could get this done for 50 cents, I would be okay with it. And right now we're at 125. So if you're worried about the risk of the trade and what the underlying stock is going to do, you can go a little bit further out, or you can potentially go a little bit wider and take a little bit less of a credit and give yourself a little bit more upside. But I would have liked to have done this trade prior to Costco announcing earnings, just in general. What do you guys think? Does the Yes, you can. We'll send out the recording. Awesome. All right, very helpful. William likes that. All right, that's awesome. I'll go back. I'll show it one last time here. Let me just pull that up because I think the modifications are real interesting. I wanted to pull up the. There it goes. There it comes back. All right. Let's see where we ended up at. Like I said, Costco has a tendency to go down usually after earnings. I don't know. They're just one of those stocks, kind of like Apple. It's flat. Did Costco announce? It's done nothing. Huh. Well, this would be a great trade if it did nothing. You could bring in $1.25. Can I modify it? If I click on the trade screen, no, it doesn't allow me to modify it. Oh, it was up 8% an hour ago, and now it's back to flat? Interesting. All right. Just put a short strangle. Yeah, put a short strangle. That would do great. I would agree with that. That would have been in hindsight. So now realize that this trade is a setup because we're doing it on the Thursday. The markets are closed, so we're able to use the Thursday options to look at a potential trade for Friday. You obviously cannot fill at those prices. So I don't want anybody to come back and say that. All I was saying that if you're looking at zero, here's the moral to my story. If you're looking at zero DTE short spreads, and that can be created in this scenario by a company that's announcing on a Thursday and you got a Friday expiration, or even a couple of day expiration. They're announcing on a Wednesday after the close. This is an interesting alternative to those trades. It builds in the hedge inside your trade and allows you some protection if the market goes against you. It's not perfect, just like every hedge. Nobody wants to hedge, right? And there's really no hedges that are, very rarely do you do a hedge where when you do the hedge, you don't take a loss, right? You're taking a loss somewhere when you're doing the hedge. This is a situation where we're embedding the hedge into the short spread. We do it up front, and it gives us some protection if the market goes against us, but it costs us something. So it's up to you to decide, would you rather have more premium or would you rather be able to sleep well at night, right? Have a little bit more protection. Oh, so, Chris says sales were up 8%. They're currently flat. Yes, I do see that. I looked on Yahoo Finance and it looks like they are up 51 cents on the day right now. 1,009. So this trade would look great in that we sold it 125 on a 5-point wide spread. And when that happens, then we I mean, you would expect to get up tomorrow and make that 125, 20% in a day. Solid, right? All right. Any other questions? I think we'll let this go. We're right at time. Yeah, the short strangle is a crazy trade. I don't like doing short strangles around earnings. You're gonna win more than not, but the one time you get your head ripped off, it's it hurts. It hurts a lot. All right, everyone. Well, thank you. I hope you enjoyed the event. I'll go back. I'll show you my stuff. If you want to follow what I'm doing, please follow me on x.com. And we'll highlight that. And we'll be back here next Thursday for the next edition of I guess it's Option Education Thursday. That's really what we should be calling it here at OptionsPlay. We're doing these events. We're trying to make them timely. Please share with your friends. Please sign up. Check out the platform. We do a daily play that we put out, well, almost every day. Sometimes we just adjust trades and sometimes we just close trades. But almost every day we put out a daily play, and it's based off of Tony's research that he does on Monday, and I usually pick the strategy. So that's where we're at. So thanks for stopping in, and we'll see you, next Thursday for sure, I hope, for the next event, education event here at OptionsPlay. Thanks for tuning in.